I saw an article in Forbes with the title, Bad Advice from Financial Advisors. This caught my eye, since I am a financial advisor. The article would be more accurate, in my opinion, if it said, bad advice from traditional financial advisors. I want to separate myself and others like me from those who follow conventional thinking and give conventional investment advice and who manage money in a conventional manner. I am squarely in the category of non-traditional advisor, more of an independent thinker with a more independent approach to financial advice and investment management. I will explain some points made in this article along with my comments I have heard from people I talk to about the advice that they have received from financial advisors, advice that turned out to be bad advice. Hi, I'm Ben Reppond. Today is September 6, 2022. Welcome to my YouTube broadcast. The article lays out some areas that they consider bad advice, and I agree with what they wrote. And it was kind of surprising that they said some of the things they did, but they did. So I took those and then I added to them some of the things that I have heard people tell me that they consider to be bad advice based on the way things turned out. And I'll go through these and elaborate a bit. When it is said this investment has little to no risk or is a low risk investment, that is said quite a bit. I've heard it said, and people have told me that they were told this or that is a low risk investment. Well, this year, 2022, we have had the opportunity to see how that turned out because it's been a very hard market, a very difficult market. And if anything has got risk associated with it, it showed up in 2022. And so that is bad advice. And so I would say to you, if you have investments that have turned out poorly in 2022, take a look at it and see. What were you told? Were you told this has got that level of risk to it? Were you told that? Probably not, or you would not have bought it. The second piece of bad advice, and this was what was a shock to me when they said this, but it's absolutely true. You should, speaking to the investor, you should shift to bond-based funds as you approach retirement. Bond-based funds. Really? Well, if you're in a 401k plan, you're given the opportunity to get target date funds. And target date funds, you pick a date and say, I'm going to retire approximately around this date. I'll be approximately this age. And the closer you get to that target date, the more and more bonds they shift into, behind the scenes, shift into the fund. You don't even know it. That's the way it works. And that is intended to lower risk as you approach retirement. That did not work in 2022 because stocks were down, you know this. Bonds and bond funds were down a lot. Sometimes bond funds were down more, or ETFs, down more than stocks. That's amazing. And so traditional buy and hold portfolios from traditional type advisors have definitely had a very challenging year and been diminished in value a lot. The third thing that I've heard many times is that it's said in different kinds of ways, the sales presentation does not match reality. Now notice I didn't say bait and switch, but it's somewhere in that category. You're told enough to get you to say yes, to buy whatever they're selling, And you have this, you relax over, and you get comfortable with the fact that when the market, this maybe you did this years ago, whenever the market has a collapse, I'm not going to have to go through what I've seen in the past when the market has collapsed. You're given some degree of assurance that things are going to work out better. That's the presentation you buy into. How has that worked out in reality? When reality does not match the sales presentation, that causes a disconnect. They say the word is cognitive dissonance. There is a separation between those two, and that doesn't go well for investors. When you are told, and it is common with traditional advisors, buy and hold investing is best. Period. Doesn't matter what age you are, doesn't matter what investments you have, buy and hold investing is best. That is promoted. It is promoted by the vast majority of financial advisors. Let's think about this. And this didn't work out well this year in 2022. If you have a buy and hold portfolio, take a look at it. Did that work out well for you? That would be the answer to the question. So think about buy and hold investing. What is this saying? What they're saying is the advisor, and by the way, the advisor doesn't pick usually the investments that go into the portfolio. They don't have the skill to do that. There's someone in a back room somewhere or in a corporate office who looks at your score and says, you need this kind of a portfolio. Doesn't matter how much risk is associated with it, because what they believe in is the concept of allocation. You allocate a little of this and this and this and this, usually 10 different things or thereabouts, in different buckets, if you will, and that's what they believe in. What is the rate of return? They really don't look at that. They don't talk about rate of return. You might talk about rate of return, you might talk about risk, but they talk about allocation. You're talking two different languages. So buy and hold investing says you're going to put together a portfolio no matter what year it is, what the market conditions are. The market can be down 30, 40, 50%, and this is what you should have. The market can be up 20, 30, 40%. That happens. Whatever, or the market's flat. It doesn't matter what environment you're in, they're going to put you in the same portfolio based on the type of investor you are. So when the market does what it did this year and it collapses, it goes down and down and down almost every month, from January through August. Every month, almost every month, the market has gone down, and it has been clearly, in a macro sense, in a downward trajectory. When that happens, they don't believe in making any changes. It doesn't matter how far down it goes. They just step aside and let it go down and down as far as it's going to go, and that's okay. It irritates them when you question that, when you say, wait a minute, do something. Just do something. It doesn't have to be the best thing, but do something. And so the people I talk to are very frustrated with the fact that advisors do very little and they end up losing a lot of money. The people I've talked to typically have lost 20 to 25% of their money, and some have lost even more. So buy and hold investing is not best, and one size does not fit all, and it does not make you very satisfied in different market conditions. The phrase that they use is invest for the long run. Now, there's an element of truth in this. And what do they say about things that have an element of truth in them? Invest for the long run is partly true. You should invest for the long run. But when that is used as a catchy phrase, when you question rates of return or risk or market conditions, etc., when you do that and they say invest for the long run, it's not very satisfying. Because of course you're investing for the long run. That doesn't answer the question. The question is, what are you doing along the way when risk enters the market to minimize that risk? What are you doing? That's the question. Investing for the long run has nothing to do with that question. You should invest for the long run, and something should be done by the person who's charging you a fee to minimize that risk. And finally, this is an area that is not talked about much. It's hidden, and you can't find it. It's for the average person, it's very hard to find. And when advisors are asked about this question, they have various ways of blowing it off. And that is that a non-fiduciary advisor, and by the way, they don't call themselves non-fiduciary advisors, just so you know, looks out for you, looks out for your best interest. Who is a non-fiduciary advisor? It comes down to licensing. If a person has passed a Series 65 test, and only a Series 65 test, they are by definition a fiduciary advisor. If they add another test to that called a Series 7, then, which most people in the investment industry have a Series 7 and 65 or 63, that takes away the title or the category of fiduciary. A fiduciary can only be a person who has a 65 only. Or if a person is a CFP, a certified financial planner, that designation after their name allows them to be considered as a fiduciary. Those two are the criteria. Who fits into that category? About a third of the advisors out there fit into the category of being a fiduciary. About 2/3, most of the ones with all the big name brokerage firms, Bank of America, Wells Fargo, Citibank, JP Morgan, Morgan Stanley, and Merrill Lynch, or any local advisor, Edward Jones, a lot of those are non-fiduciaries. They have passed a Series 7 and 63 or 65. And what that means is, so about 2/3 of those out there are not fiduciaries. What does that mean? It means this: if they legally, they have to represent and look out for the best interest of the company they work for, not you. It doesn't mean they don't look out after you. It means that their primary loyalty and their primary focus is the company they work for. Legally, that's what it means. Along with that, what it also means is that usually, in many cases, they sell, they don't act as an advisor. They may seem like they do, but they're really selling something that has a commission attached to it. There's nothing wrong with receiving a commission. When you buy certain products, you expect someone to make a commission. That's reasonable. But in the area of financial products related to your money, if you buy a fund or some kind of investment that is sold to you by a person who calls himself a financial advisor, where does that money come from to pay that commission? It comes from you. It comes out of your account and goes into their pocket. So that's where you begin. Right off the bat, a commission gets paid from you to them. When you say, well, I didn't authorize that, you don't have to authorize it. You say, well, they should disclose it. Well, most of the time they do not, but if they do disclose it, it's in the fine print. Good luck finding it. That's the way the industry works. And you may say, well, my advisor is a wonderful guy or woman, and they're a wonderful friend, and I know them well, and they would never do that. Okay, that's fine. You're entitled to your opinion. I'm just telling you how it works. And so I've seen people who, when they dug into it, were surprised at the way this works. All of this does is take away from rate of return. And if you said, well, I only want certain kind of investments. Well, they will sell you whatever they are told to sell you by the people above them. Vast majority, I know of almost no financial advisor who puts together their own portfolios. It is someone else, another organization that puts it together. And you know this because if you ever say to them, what is it that I have in my portfolio? And they'll scramble around and try to get you some names. And then here's the trick question. Could you tell me why I have that in my portfolio? That's a fair question. Why do I have this combination? I want a specific answer. Let's go fund by fund or ETF by ETF. I want to go by each one, and you tell me what that is and why I have it. That will be a very difficult conversation for them. And all of this comes back to, are you dealing with a fiduciary or a non-fiduciary? Now, I'm going to switch gears, go over into economics. We're going to go over into the economy, and I'm going to start with jobs, and then we're going into housing, and then I'll come back to the stock market. So last week, this was we had a very favorable. A week ago, last Friday, we had a very favorable jobs report, and I'll play you a piece from Bloomberg that shows that. And there are right now, so let's look at job openings, and then we'll get to jobs. Job openings, there are 11.2 million job openings out there. And that is almost double the amount of people who are looking for jobs. So let's say that number is 6 million. 6 million are looking for jobs. There's 11.2 million jobs available. Assume that the skills and the job requirements reasonably match up. That means that there are, on average, 2 jobs available for every person looking for a job. That's a favorable environment for the economy. And we're kind of at full employment. If you want to work, you can probably get a job. This is, when you put this on a chart, you can see the 11.2 million job openings on the chart and where that's been over time. Now I want to play a piece from Bloomberg, and this came out after the jobs report on Friday. And it was announced that there were 315,000 new jobs added for the month of August. And the way they're saying this is the beginning of the market on Friday, the beginning of the day. After the report came out, they did this piece. And then following this, I'm going to do another piece, both of them from Bloomberg, showing a different perspective. But this will show that they're saying basically this is a very good report. It was 576,000 the previous month. It was estimated to be close to 300,000 in August, but it came in over that at 315,000. You would have thought that that would be extremely good news for the market, and it didn't turn out that way. But I want you to play this. It takes about a minute. I want you to listen to this, and then from here, I'll go into a different view from Bloomberg.
August non-farm payrolls figures were released this morning, and the numbers were solid and not overwhelming. The U.S. economy continued to create jobs at a good pace in August. Non-farm payrolls rose by 315,000 jobs, short of July's 526,000, but a beat versus the consensus forecast of about a 300,000 job gain. Wage growth was lower than expectations, but that could be good news from the Federal Reserve's perspective. Average hourly earnings rose by only 0.3% versus expectations of 0.4%. The year-over-year wage growth figure stayed steady at plus 5.2%. The unemployment rate ticked up to 3.7% from 3.5% in July, its highest level since February. But this was offset in part by a move in the labor force participation rate, which rose to 62.4 from 62.1. As of this August report, total non-farm employment is now 240,000 jobs higher than the pre-pandemic level in February of 2020, which is very welcome news.
Now I want to play this. This was actually, I'm playing them in kind of reverse order because I wanted you, it's interesting. This is from Tom Keene and Jonathan Farrow, and they are, before the market opened and before this report came out, they are speculating that this is going to be a good report and it will be seen as bad news. And you may say, wait, what a minute, what's that? That makes no sense. Correct. It happened as they predicted it would happen. It was favorable, as you saw from the previous clip, and the market, the stock market, started out with a gain of about 1%. That's a lot for a day. Started out, that's where it opened. From there, after the report came out, it went down and the market ended with a loss. The S&P and Dow ended with a loss of 1%. Started out +1, ended -1 on a very favorable jobs report. And so Jonathan Farrow talks about this in this piece I'm going to play you, and it is interesting. Good news is bad news. And why is that? In my opinion, the reason is we're in a bear market. And even when good news, and the reason they speculated it was going to go that way, because that's the way all the other reports have been, is that they would come out with good news and the market would go down. So take a listen to this.
For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow, together with Anna Edwards. Bramo back after the long weekend. Equities unchanged on the session. TK, we are down on the week. And every day since Chairman Powell spoke last Friday, yields inching higher at the front end.
This will be a different jobs day. We will cover the American labor economy, the report of mystery. We'll have to see what it's like after last time's festivities. But John, these markets say it can't be a normal jobs day. Yen, where it is, Philippine peso, truly record weakness.
Well, Tom, last month there was nothing normal about it. 528. Today the estimate 298. A week full of better than expected data. ISM manufacturing better than expected, claims lower than expected, consumer confidence firmer than expected. Tom, that's been the theme of the week. And you know you hate this and I hate it too, but good news has been bad news.
Oh, you're going to start right in on that.
Just go straight there.
John, Jim Glassman was maybe the best interview I've had with him yesterday for 35 years.
What did he say, Tom?
The giant of JP Morgan Chase. He was heated that the Gloom crew has it wrong. Heated.
Anna, does the Gloom crew get a bit of fuel for their debate a little bit later?
Yeah, well, let's see if good news, if there is good news, does it turn out to be bad, as we've seen recently, John? Yeah, the Gloom crew dominates. I mean, all the conversations we have with those in equities, certainly, I mean, it's difficult to find those who are positive. Every now and again we find one, but they're scarce.
We've established that good news is bad news. Is bad news good news? Anna, do we know?
No. I read yesterday from one of our guests that bad news is definitely still bad news. So basically everything's bad.
TK,
Sorry, I know that's not a Friday message.
Tom, you up to speed on this?
Okay. Going to shift gears, go over to mortgage rates. The 30-year fixed rate, now this is a chart showing where this has been from 2018 to 2021 up to present. So you can see that the mortgage rates on the 30-year fixed mortgage in 2018, 2019 went from 5% down to 3%. And if a person got a 10 or 15-year mortgage, there were rates that actually got as low as 2.5%. Look at where it has gone since that time. In less than a year, maybe, a little less than a year, gone from, on the 30-year fix, from 3% up to 6%. 6% in a very short period of time. Very interesting. What is this going to do to housing? It's going to definitely put a damper on housing. And is it going to show up right away? Probably not. And it will be regional. There will be areas that'll be doing very well, other areas not so well. But in general, if rates continue to rise, that's not good for housing. Rates will probably rise. They typically rise when the Fed raises their rates, the overnight bank rate, mortgage rates tend to follow, as do bond yields. This is an inflation-adjusted home price index, and you can see where this has gone and where it is expected to go in the future, and that is definitely down when adjusted for inflation. This is a report from Goldman Sachs Global Investment Research, and they show this is through the first quarter of 2022 in the dark blue, and the light blue is the implied home prices, and this is not fact, this is projection. So you can see they are projecting home prices, the rate of increase in home prices to come down pretty quickly and then to flatten out. This does not say necessarily that prices are going negative, but that they are flattening out. This will probably produce an excess of homes in the market and will probably at some point start to have an effect on prices. These are the expected decreases. There are some areas that are not expecting decreases, but these are the odds of regional home prices dropping over the coming year. And so in the dark red, you can see, particularly in the West, you can see there are areas that have a higher chance of price decreases than other parts of the country. It looks like maybe in the panhandle of Florida there's one, and in New York City there's one, maybe in Boston. Other than that, either not expecting decreases or not as at risk as those areas that are in red. Google tracks what people search by, and when they track the phrase, "sell my house," this goes all the way back to 2004. What percentage, what is the number of people who are searching for the phrase, "sell my house"? I don't know where they're going to go with that search, but they're searching for "sell my house." Look at where that is today. It is at an all-time high. So whether people are selling their house, thinking of selling their house, they are at least searching for information about selling their house. Now I'm going to play a piece from Bloomberg, and this is on the housing market, and it definitely shows that thing based on their information and the data that they look at. They talk about the market cooling off. They begin with this very concept. The reason it's caught my eye, they begin with this concept of searches for selling my house. So, but I just showed you the chart on it. So, but this is a piece from them showing that what they believe about the housing market cooling off.
Many people are searching housing crash in similar terms now than at any time since 2007, according to Google Trends data. The last time the U.S. housing market looked this frothy was back in 2005 to 2007, and then home values crashed, and we all know what followed. The U.S. housing market may be starting to slow down, but it is still hot. Home prices are still 15% higher than they were last year. But with the housing boom threatened by soaring mortgage rates and a possible overall economic recession, is the U.S. housing market facing a cool down, or is this sector, which accounts for about 4% of GDP, already in a recession? Existing home sales have been down for 6 straight months and are now 20% below February levels. Builder confidence has plummeted, and there is a skilled labor shortage.
Okay, shift gears a little bit again, go into car sales. This is a U.S. light vehicle inventory. The price of cars, particularly used cars, has a lot to do with inventory. The lower the inventory, the more they charge for the car. That means less supply and, relatively speaking, higher demand. So this has dropped. Car prices have continued to go up. Used car prices in particular continue to go up. And this chart explains why. I'm going to shift again over to the stock market. This is the S&P historical composite. And it does three things that make this chart credible and useful. One, it's a logarithmic chart, which shows the percentage change, not the dollar change. Secondly, it is inflation adjusted, which you very seldom see that. And thirdly, there is a regression line that goes through the data. The bear market conditions, there were 4 of them in the last 150 years, 4 bear markets. And here we are today. At the very end, the very right of the chart, we have tipped into bear market territory. And so we would be what's called right now a cyclical bear market, but this could turn into a long-term secular bear market. It has not yet turned into that, but when the market goes down 20% or more, that by definition is considered a bear market, and the S&P 500 did drop to a point in June where it was down 22%. So by definition, we're in a bear market. That, as you can see from this chart, does not mean the market or the economy is going to go straight down. It usually goes down in some kind of a jagged fashion. Keep in mind that this chart is compressing 150 years of data into a few inches. So it is definitely a macro chart. When you look at the regression line going through the middle of the data, you can see that how far we are still above even the regression line. But bear markets not only go down to the regression line, they go beyond it, and sometimes they go beyond it quite a ways. So if we are at the beginning of a secular bear market, we have a long ways to go. But it could take a decade and a half to go through this. And there will be, as there have been in the past, some excellent opportunities to buy in there, which is why we use a mathematical approach to our investing, because we want to take advantage of those when those occur. And in every instance, including the Great Depression, especially in the Great Depression, there were some amazing opportunities right in the heart of the Depression for excellent buying opportunities. So that's why we do it the way we do. But I would say if this line at the very far right of the chart turns into a red line over time, it would not surprise me. Okay, I give you the flow of funds report showing where is money going. The large amount of money, where is it going? Is it going into the market or out of the market? And there's 3 places to look. The first place is stocks, equities. 10.6 billion last week left the equity market. Well, where did it go? Well, let's take a look. What about bonds? Did it go into bonds? Bonds had an outflow of 9.2 billion. Well, it didn't go into stocks. It didn't go into bonds. Where did it go? How about money market? Money market had outflows of 6.9 billion. Where did the money go? Not just the 10 billion, but the 26, 27 billion collectively. Where did it go? Well, I don't know. But I suspect that precious metals might have attracted some, maybe commodities, maybe people just took it out and put it in a can in the backyard. I don't know. We don't know what they did. But it did not stay in the equity market, the bond market, or even in money market funds. I thought that was interesting. Okay, I'm going to show you some dashboards, 3 of them. One is, this shows the 6 major indexes, 4 U.S. and 2 foreign indexes. And if you're new to watching the channel, I'll explain what you're looking at. The top 3 lines are U.S. equities. The bottom line is U.S. equities. And between those are foreign equities. I will explain. I go across the chart, and I'll come back to going down the chart. Go across the chart, and there are 5 sets of numbers. The weekly percentage change, the monthly change, the last month, the quarterly change, and the year-to-date change. If that change is positive, that's a green number. If it's not, it's a red number or a pink number. I put it in pink so you could see it better. And then at the far right are moving averages, the 20, 50, 100, and 200-day moving averages. Is this index above its moving average in those cases, or is it below? If it's below their moving averages, it is a red dot. That's generally, looking in the rearview mirror, that's a bearish condition. With 6 indexes and 4 moving averages per index, that's 24. There are 0 green dots. All 6 are below all moving averages. You won't see this very often. We've seen it this year before, but will it last? It's not going to last. But at some point it will turn. Some of them will turn and start to go up. And in my opinion, that will probably be what I call a head fake, and then it will continue on its path down, because I believe we're in a longer term bear market. But it can go up, and it can go up for a while. It can go up for weeks, even months. And so you need to be aware of that. When you go down the chart, you see the dashboard, you will see there are symbols over on the far left, and then next to that are descriptions, and they represent the Dow Jones Industrial Average, the S&P 500, the Russell 2000 Small Cap Index, the Emerging Market Index, the Developed Country Index, primarily Europe, Japan, and Korea, and the NASDAQ 100. So in the 5th column of numbers, you will see that's in descending order. The Dow has lost 13% of its value, S&P 17, etc., all the way down to the NASDAQ 100, which has lost 26% of its value since January 1. The S&P 500 has 11 sectors, different types of industries, all different kinds. I mean, like consumer staples, healthcare, energy, financials, real estate, technology, etc. Different aspects of our economy. Sometimes they usually go in different directions. In this case, when we measure for the week, the month, the quarter, and year to date, very, very few are in green numbers, which means that everything that is not in green, which is in pink or red, is negative. And they are all, and I do the same moving averages, the 20, 50, 100, and 200-day moving averages. And so all of these sectors, with the exception of energy, which is oil companies, are below their moving averages. Energy, oil, is up 44% year to date. Everything else is down, somewhere between 5% and 30%. And since this makes up the S&P 500, I showed you in the previous chart that the composite, based on a weighted allocation, based on their size, a weighted allocation, the S&P 500 is down 17%. So even with oil or energy up 44%, the composite is still a minus 17%. And there are 4 green dots out of 44. Last week there were 15 green dots. That tells you what kind of a week it was. And finally, I want to show you there are 4 assets. The S&P 500, represented by SPY, TLT, which is the long-term government bond, NASDAQ 100, and then I put Coinbase in there as a surrogate for the crypto industry. So S&P, we know that's down 17. Government bonds down 25%. That's not supposed to be down when stocks are down, but it is, which is why this year has become such an incredibly challenging year for investment portfolios because, in my opinion, financial advisors do not know how to deal with a market that has appeared for the first time like this in 40 years. Since 1982, they have not seen anything like this. Why? Because interest rates are now starting to go up, which means bond yields are going up, which means bonds are collapsing. And corporate bonds even more so than government bonds. And then NASDAQ 100, heavy tech-weighted index, down 26%, and Coinbase down 74%. Now I'm going to switch gears again, go into charts. This shows the S&P 500. For the last year, it's a weekly chart showing the movement. One move, one change represents 1 week. So there should be 52 moves in this line over a 12-month period of time. And you can see, and then a moving average, a 20-period moving average moving through the data. That's a blue line. And then I put a black arrow on it to show a little more of a macro view of that the market in general since December, late December, is in a downward direction and is continuing based on last week's decline and the previous week's decline and the week before that decline is definitely moving down. There was a head fake where it went up for several weeks, but then it turned around and continued its downward trajectory, which I believe that's going to continue for a while, even if we get an uptick. I'm not forecasting and saying it's going to happen. It just wouldn't surprise me if it does. And this takes the S&P 500. There are two exchange-traded funds, ETFs, that I put in a ratio, and I chart the ratio. The numerator is SPY-G, which is growth stocks. So the S&P 500 has growth stocks in it like Google and Apple and Microsoft, etc. Those are the numerator. The denominator are value stocks. Companies like JP Morgan, Pfizer, Boeing, etc. Those are value companies, more focused on profit than on growing revenue. Growth companies are more focused on growing revenue than profits. And both of them are interested in both categories. It's a matter of emphasis. So you can see by the trajectory of that black arrow and the trajectory of the line that growth has been out of favor relative to value for all the way back to November. So about 9 months that growth has been out of favor in general and value has been in favor. That will change at some point where value comes back into favor, but at this point it's a value-oriented market that's doing better performance-wise than growth. Now switch from a 12-month chart over to a 24-month chart to give you a longer perspective, and this puts small cap, IWM is the ETF, small cap is the numerator, and SPY, large cap, is the denominator. So how are small companies doing relative to large companies? Measured over a 24-month period, this is really interesting. Look at the first part of the chart. This would be, 7 months or so? Went straight up. That means small cap was in favor, and then that changed. And then large cap came into favor. That doesn't mean large cap companies went up in value, because we've already seen that the S&P 500 index, all of the indexes went down. It's just relative to each other, how did that look? So you can see for 17 months or so, that generally speaking, small cap was out of favor. Now I go away from the relative difference, the ratio, and come back to an absolute chart, and this is a 30-month chart. I do 30 months because I want to show you something. This is the long-term government bond, represented by the ETF TLT. You can see that going back about 2 years ago, the downward trajectory of bonds, and then they went up. I call that a head fake for a period of time. You think, oh, well, maybe they're going on back up. Maybe we got that out of our system. No. They came back down. Look at the arrow on the far right. Do you see what that's happening? We are in a period of decline for bonds and stocks. Will that change? Yes, it will change. But for now, this shows, at least government bonds, and actually corporate bonds are even worse, that the downward trajectory of bonds. And why is that? Because interest rates are going up and bond yields are going up. Now I'm going to switch to precious metals, and this is a 48-month chart. Again, an absolute chart, not a relative chart. This shows, look at the period of time, which would be approximately 2 years, where gold was surging up. And then it has generally been in a period of slight decline for the last couple of years. Up and down, but generally speaking, a downward trajectory. Now let's do the same thing for silver. Now I'm going to switch on silver to an 18-month chart because I just wanted to show the specific direction for the last 18 months. Silver is down, and it is down more than gold. And I'm going to put that on the next chart. And this charts the ratio of silver to gold. Silver is the numerator, gold is the denominator, represented by the ETFs, SLV and GLD. So you can see, going back, this is a 24-month chart, so for about 18 months, silver has been less in favor than gold. Gold has gone down, but it's gone down less than silver has gone down. I'll show you that in a minute. Pretty interesting chart. Will this change? Yes, this is going to change. Silver will go back up and gold will go back up. And there will come a time where silver will be more in favor than gold. But right now, that's not the case. The volatility index, called the VIX, V-I-X, measures volatility, especially downward volatility in the market. So this is a 12-month chart showing how it's measured, and I put a bar in there, a line, at the end of the chart to show an artificial number of 24. That's considered, when it's above that period, it is a period of higher risk. When it is below that period, typically it is a period of lower risk, particularly if it's the trajectory of the index is in a downward direction. So you can see that the market, from the volatility index standpoint, is higher than the norm set at 24. And again, there is no pattern. I didn't put an arrow on it because there's no pattern. It's just up and down, up and down. So it's now been going up, but we'll see where it goes from here. Okay, Asbury Research does some metrics. This is a chart where they do 6 metrics measuring different components, many of them fundamental components of the market, and then they code that as either a positive or negative indicator. As of Friday, the Asbury 6, the 6 indicators that Asbury Research uses, all of them were negative. Not inconsistent with the data that I've shown you before. This is a relative chart, relative performance chart, where Asbury compares certain indexes to other indexes. Which one is more in favor? So from a relative performance standpoint, the ones that are in green have the most pronounced outperformance, if you will. Now, they could both be going down, but one could be going down less or quite a bit less than the other. If that happens, the one that is going down the least could show winner with a green box, not because it's going up, but because that differential is big enough to get a green box. So low volatility stocks versus high beta or high volatility stocks. Low in a down market, it's no surprising. Low volatility stocks are going to be more in favor. They're going down, but they're going down less. We've covered this before, the S&P 500 versus the NASDAQ. You know, the broad market versus the growth market. No surprise, the S&P 500 is outperforming. And then the U.S. is outperforming the developed markets, even though, and you saw that in a previous dashboard, even though both of them are down. The U.S. is down less than developed markets. And then on bonds, remember how bad I showed you government bonds are doing? They're horrible. Guess what's more horrible? Corporate bonds. So which one has done better, government or corporate? Government has lost less value than corporate. And no surprise that on short-term or long-term bonds in a declining market for bonds, short-term is going to be down, but down less. When the U.S. is compared to countries around the world, last week there were 3 countries that outperformed the U.S., Chile, Brazil, and India. This week, there are 6 that are outperforming the U.S., Chile, New Zealand, Malaysia, Brazil, India, Russia, and Thailand. Not necessarily ones you would have picked, but they are outperforming when you look at the ETFs for those countries compared to the U.S. market, which is represented by SPY. Advisor Perspectives is a publication which I take, and they provide macro indicators looking at a 10-month, the S&P 500 relative to a 10-month simple moving average, a 12-month, and a 10-month exponential. And in all cases, the S&P 500 is definitely below all 3 of those moving averages. The Vanguard has some ETFs. One is the total stock market for the world, VTI. The other is the total stock market for the world, excluding the U.S., BEU. And then IEF is the intermediate term government bond, and BNQ is the global real estate market. In all cases, all of those ETFs are down significantly below their moving average, which is a 10-month simple moving average. DBC, which is the ETF for commodities, is above its moving average and probably above numerous moving averages, and they have been invested in that index. But other than that, it's negative. Gold and silver. Negative week, again a negative week for gold and silver. Gold is at $17.13 per ounce. Silver is at $18.04. Gold being down 2.8% and silver being down 5.4%. And I've shown you the charts on those. And finally, I think the bull market, at least for now, is deceased. And I think pretty much ready for burial. We don't know when it's going to resurrect. It will. We just don't know how long it's going to be. There's a lot of opinions out there, and they're all opinions. I'll try to stay away from that, but I will say it won't surprise me if it continues to go down, at least on a longer-term basis, with short-term periods where it will try to go up and then collapse. That's at least been the pattern so far this year, and it is also a pattern in previous bear markets. Thank you for watching. If you have questions or comments, leave them in the comment section below, and I will try to respond to them. Again, thanks for watching.